Let me ask you a very important trading question. Have you ever followed the trend and bought a stock because it was bullish, only for price to suddenly reverse and stop you out? Or sold at resistance just to watch price keep flying higher? This exact question has been coming up a lot recently in my trading group community, and I realize many traders are confused about it. So today I'm going to break it down clearly for you. Now, the big question is, which one is actually better? Following the trend or trading support and resistance? And more importantly, when should you use each one? Because here's the truth most traders don't tell you. Using the wrong strategy at the wrong time is why most traders lose money. So without wasting time, I'm Rikia. Welcome to the channel Trade with Raks, where we teach how to build wealth and gain financial freedom through trading and investing in financial markets. If this is your first time here, don't forget to subscribe and turn on the notification to get notified anytime I upload new videos. Let's aim for 1000 likes on this video so more people can learn and become better at trading and investing. And make sure you watch till the end of this video because I'll show you when trend following makes you money, when support and resistance work best, and how smart traders combine both. Let's get right into it. First, let's get a simple explanation of what a trend is. In trading, the trend is simply the direction of the market. There are only three types of trends in the market. 1. An uptrend, which is when price makes higher highs and higher lows, closing higher than prior candles. 2. A downtrend, which is when price makes lower highs and lower lows, closing lower than previous candles. And 3. The sideways trend, where price is moving in a range. And there is a popular saying, the trend is your friend until it bends. In a strong uptrend, buyers are in control. In a strong downtrend, sellers dominate. Trend traders make money by joining momentum, not fighting it. But here's the catch. Not every market is trending, and that's where many traders get trapped. Now let's talk about support and resistance. Think of it this way. Support is a price level where buyers step in and pushes price up. And resistance is a price level where sellers show up and pushes price down. Support acts like the floor, while resistance acts like the ceiling. Price reacts at these levels because institutions place large orders there and traders remember these price levels. So psychology plays a big role. Support and resistance traders make money by buying near support or selling near resistance. It sounds simple, right? But here's the problem. Support and resistance works beautifully only when the market is not trending strongly. Let's talk about when you should follow the trend. Trend trading works best when the market is making clear higher highs and higher lows, and when there is strong momentum, or when the stock is on the news, or releases earnings, or its fundamentals support the move. This is when strategies like trendline entries or moving average pullbacks or a breakout continuation trades work extremely well. For example, a stock breaks above resistance with volume, pulls back slightly, then continues higher. That is a strong indication of a bullish trend. So trend traders buy the pullback. Now here's the mistake beginners make. They keep selling resistance in a strong uptrend. That's like trying to stop a speeding car with your bare hands, like fighting momentum when momentum is clearly in control. And yes, you already know how that ends. That's a losing battle. Now let's flip the script. Support and resistance works best when the market is ranging and price is respecting clear highs and lows. There is no strong trend. This is where range trading strategy, mean reversion, and bounce setups dominate. For example, when price keeps bouncing between $10 and $12. So smart traders buy near $10, which is support, and sell near $12, which is resistance. But here's the danger zone, using support and resistance in a strong trending market. Because when resistance breaks, it becomes new support. and traders who keep shorting get crushed. Likewise, when support breaks, it becomes new resistance, and traders taking long positions get crushed also. Now, here's the biggest mistake traders make. They choose one strategy and force it on every market. So they sell every resistance in an uptrend and buy every support in a downtrend. This is so wrong and would only result in losses. Let me be very clear. Trend trading is not for ranging markets, and support and resistance is not for strong trending markets. Professional traders, before going into any trade, first ask one question: what is the market environment right now? Only then do they choose the strategy. And this is the mindset shift that separates profitable traders from frustrated traders. And now, let me show you the pro move. Smart traders combine both strategies. And here is how. First, identify the direction of the market. In an uptrend, the trend line acts as support. So when price pulls back to the ascending line, smart traders buy the pullback. And in a downtrend, identify the trend first and use resistance levels to sell rallies. That's short selling. So this way, you are not fighting the trend. Instead, you are using support and resistance within the trend. And this single adjustment can dramatically improve your win rate. So let's wrap this up. Follow the trend when momentum is strong and use support and resistance when the market is ranging. And for smarter entries, combine both strategies. If you found this video helpful, don't forget to smash the like button. Subscribe for weekly trading strategies, market breakdowns, and real examples. Also, drop a comment below telling if you're a trend trader or a support and resistance trader. Thanks for watching and see you in the next video.